The year's almost over, and let's be honest, you've probably planned to get rich by now, right? We all make lofty New Year's resolutions, but then find ourselves stuck. That's why in this video, I'll be revealing to you the stock market's best kept secret to wealth. 12 dividend stock assets to buy that could make you rich by 2024. Intrigued? Then let's get started. Preliminary disclaimer. Before we jump into the main event of today's video, let me throw out a quick disclaimer. I'm not a financial advisor, and this video is not to give you financial advice, but for educational purposes. You can always do your research and talk with a financial advisor before making any investment choices. Now that we've got that covered, let's get into why you're here. Those 12 dividend stock assets that could set you on the path to riches by 2024. Section 1. The dividend stock phenomenon. Until this video, you probably thought dividend stocks are boring, only meant for old money investors, too complicated, and don't generate enough profit, right? But that's not the case. Dividend stocks are companies that pay out a portion of their profits with you if you're a shareholder. These profits may come to you every month, quarter, or annually.
Company, you invest inside the stock market into these companies that pay out dividends, high dividends. They're called dividend paying companies. A way to say thank you for investing inside our company. Hopefully you could reinvest those dividends back inside our company to help it grow.
Now, I get that a dividend stock might not be all fancy like crypto and NFTs, but they're a sure path to long-term success. Things to consider when choosing a dividend stock. Before jumping on any stock, you should use some key factors to know if a stock is right for you. Some of these factors are dividend yield. A dividend yield will tell you how much income you can earn from your investment relative to its current price. An increasing dividend yield is generally seen as a positive sign if you're an income-seeking investor. A low dividend yield, on the other hand, may not be attractive to a new investor, but it's sometimes the way growth-oriented companies that reinvest their earnings back into the business instead of paying out high dividends behave. So you have to monitor a company's financial health before investing, irrespective of a high or low dividend yield. Free cash flow. This is the cash the company you plan to invest in has left after covering its operating expenses and capital expenditures. A company with consistently growing and positive free cash flow is often a sign of financial health.
It's true that the stock market can be volatile, but by focusing on companies with a history of paying steady dividends, you can reduce the risk. And if a company is able to pay dividends consistently, it's often a sign that they're a well-managed and financially stable company. Plus, dividend stocks have historically outperformed non-dividend paying stocks over the long term.
Payout ratio. This refers to the ratio of dividends paid to shareholders to the company's earnings, usually expressed as a percentage. A payout ratio shouldn't be too high, as this is a potential red flag, and not be too low, as this may mean the company is hoarding cash from investors. Section 2. 12 dividend stocks to consider. Let's have a rundown of these dividend stock assets. AT&T, NYSE-T. First on the list is AT&T. Now, when you hear AT&T, you might think of a reliable, if somewhat old school, telecom giant. And you'd be right. But here's where it gets thrilling. The stock currently trades at prices we haven't seen in nearly 30 years. In other words, the stock is trading at 5.7 times next year's earnings estimates and less than 1 time the revenue and book value. Here's the cherry on top. The stock is down 22.5% year to date, pushing its annual dividend yield to a whopping 7.8%. So now is the best time to hop on it. And let's not forget the 5G rollout, which is basically rocket fuel for telecom companies right now. For the long term, I'd suggest you watch this stock. Clearway Energy, NYSE-CWEN. Next is Clearway Energy. What you'll like about this stock is its grit in facing market adversity. Sure, interest rates rise and the stock dips, but don't let that fool you. Despite being down 21% this year and 34% over the past 12 months. This company has a clear vision for the future. It's a top choice if you're looking for solid dividend income. The best part? Clearway knows how to expand its cash flow. They've increased their dividend for the 12th consecutive quarter to 38 cents. They're also setting a roadmap to grow their dividend between 5% and 8% annually. That's the consistency you can bank on. And let's talk about their parent company, Clearway Energy Group. It has many renewable energy projects just waiting to be rolled out. This is a company with room to grow. Plus, Total Energies, a significant player in the global energy market, recently acquired a 50% stake in the parent company, paving the way for even more growth opportunities you can benefit from by investing in this stock. AROS, NYSE, ARCO. Next up, we've got AROS. You may not know this name, but you're familiar with McDonald's. AROS is the largest operator of McDonald's restaurants in Latin America and the world's largest independent franchise of this fast food empire. So essentially, it's the Big Mac of McDonald's in Latin America. Their dividend stock trades at 14.8 times trailing earnings and only 11.3 times next year's estimates. That's what I call a deal. And don't let the modest annual dividend of 20 cents per share confuse you. It's a good beginner, yielding 1.5% annually, especially after the stock's nearly 30% uptick this year. The company has a payout ratio of 22%, like saying, hey, we've got plenty of room to grow this dividend. And if you think that's cool, Wall Street is projecting its earnings to grow at a 43% compounded annual rate over the next 5 years. That's right, 43%. If your goal is long-term, then this is your stock. Brookfield Infrastructure Partners, NYSE, BIP. So what's so special about Brookfield, and why should you even bother investing in this stock? Well, they aren't your run-of-the-mill utility company. They're one of the big dogs in the game, owning and operating everything from railroads to data centers to, yes, traditional utilities. Their diversified portfolio is like a financial safety net, ensuring that even if one sector takes a hit, the others can balance it out.
So 2003, as many of you know, has been another solid year for us. Not only did our assets generate the sustainable results that we've come to expect, but we also were extremely successful in executing our investment and capital recycling plans. I'm going to begin with our results. As we said in many investor days in the past, our business is well positioned to prosper in almost any business environment. In spite of higher interest rates and weaker economic conditions, our infrastructure assets are on track to deliver strong financial results that benefit from higher revenues due to the compounding effect of inflation.
And here's the kicker. Their shares are down 20% over the last year. Now, most people would run at the sight of this, but not us savvy investors. This is a golden ticket, an ideal entry point to invest in a utility asset that's anything but ordinary. The company also sports a juicy 4.7% annual dividend yield, aiming to grow between 5% and 9% annually. That's not just stable, that's growth you can take to the bank. Enterprise Products Partner, NYSE, EPD, operating an expansive network of over 50,000 miles of pipelines, massive natural gas storage facilities, and even petrochemical storage. Enterprise Products Partners, a midstream energy giant, is one stock you want to watch. This company offers a whopping 7.5% yield on its $2 annual dividend. Now, a high yield usually rings alarm bells, but not here. The company has a distribution coverage ratio of 1.6, indicating a safe dividend. If you're looking for a high yield, steady income asset in the energy sector, then don't sleep on this stock. Verizon Communications Inc., NYSE, VZ. You know how everyone's glued to their smartphones these days, right? Well, Verizon is one of the big reasons why. They're the largest U.S. wireless carrier and offer landline and broadline services to millions of customers. Verizon is not just a leader in the telecom industry, it's also a strong dividend payer. I'm talking about a 7.9% annual dividend yield, the highest you would find on this list. And before you ask, yes, this dividend is as reliable as their network. They've been paying it out for years. So if you're all about that steady income life, Verizon should be on your radar. Honeywell International Inc. NYSE HON. This isn't just any company. It's a conglomerate with hands in many industries: aerospace, building technologies, performance materials, and safety solutions. So no matter how the wind blows, Honeywell will likely make money from it.
Seeing in real time across your portfolio, across end markets, across the world right now?
So I would start with saying we printed pretty good results for Q2. We were on the upper end of our guidance for EPS at 2.23. Our upper end of guide was 2.25. Very strong cash flow, free cash flow up 34%. Our backlog is up 5%, and we raised our guide for full year. So we are pretty pleased with the results. Looking ahead, I would say we feel pretty good about 23 and look ahead for 24. Our end markets are pretty strong, aerospace and energy. And there's no reason we are going to perform pretty well for the rest of the year and the times to come.
Now, I know you're probably thinking conglomerates are old news, but hold on a second. Honeywell has generated around 34% free cash flow growth year over year in the second quarter of this year and has consistently provided investors with a reliable dividend payout. Currently, it's offering an annual dividend yield of around 2.2%. I get it, that's not jaw-dropping, but remember, stability is the name of the game with Honeywell. The company is also projecting to grow its earnings organically by about 1 to 4% year over year in 3Q23. That's the kind of steady growth that, combined with their consistent dividends, makes this stock a strong contender for your long-term portfolio. The Goldman Sachs Group, Inc., NYSE GS. Goldman Sachs is a fantastic pick for anyone eyeing the financial sector for dividends. Currently, the company is dishing out a 3.4% annual dividend yield. In finance, that's pretty respectable, considering the banking crisis this year. Financial metrics aside, Goldman Sachs is also strategically diversifying its income streams. Sure, they've got their bread and butter investment banking, but they're also expanding into retail banking and asset management. Diversification is the cornerstone of resilience, and Goldman Sachs is doing it right. So if you're shopping for a dividend stock in the financial sector with room for growth, Goldman Sachs should be high on your list. 3M Company, NYSE MMM. 3M is the company behind many consumer products. We're talking about adhesives, window films, and a bunch of other stuff you probably use daily but never really think about where it came from. This company doesn't just make consumer products. They're also big in healthcare, safety equipment, and even electronics.
Let's get inside the quarter here. I think margins were better, perhaps even far better than many of the analysts who followed the company had anticipated for the third quarter. So what's driving that? Can you maintain it into 24?
Yeah, David, as you said, it's been a solid quarter for us in Q3. We're executing our priorities well. We're delivering results. You highlighted some of them. We had adjusted earnings better than expectations. We grew those year over year. We grew our adjusted operating margins year over year. Importantly, behind that, we grew sequentially in all four businesses, our adjusted operating margins, and delivered our third consecutive quarter of strong double-digit growth in cash flow. So
this wide array of products gives them a sort of built-in buffer against economic downturns. In other words, their business model is not limited to a particular sector. So what's this mean for its stocks? With a 6% annual dividend yield, you can rest assured that they are reliable and have excellent growth potential, considering their stable and diversified business model. The Travelers Cost, Inc., NYSE TRV. Travelers isn't just a good insurance company, it's also a solid investment opportunity. Whether you're new to the investing game or an old hand, this is one stock you want to pay attention to. Now, if you're asking yourself why you should pick up shares of an insurance company right now, let me break it down for you. Travelers has been incredibly consistent. They've been paying dividends for over 21 years. We're talking about a track record of stability here, folks. In an unpredictable market, this kind of stability can be a godsend. The stock currently offers a 2.5% annual dividend yield. That's a pretty good offer because this company's commercial insurance business has an excellent profitability outlook for years. Dow Inc., NYSE, DOW. Dow is a big name in the materials science sector if you're unfamiliar with this company. These are the guys who make the stuff that goes into many products you use daily, from plastics to chemical for water treatment, etc. Dow is currently offering a hefty annual dividend yield of 5.2%. This is a company that has been around for over 120 years. They know their business and they know how to adapt. For long-term investors, that's what they'll call a good offer. Walgreens Boots Alliance Incorporated, NYSE WBA. Last on the list is Walgreens Boots Alliance, trading under the ticker WBA. They're a dual force in the healthcare world, acting as a drugstore chain and an integrated pharmacy and healthcare services provider. It offers a massive 7.3 annual yield, making it a decent pick for long-term investors. Performance-wise, the stock's had its ups and downs. Just last month, it was down by 29% due to temporary reasons, but it's shown some resilience recently. If your goal is long-term, it should be on your radar. And that's it. Don't be the person who watches this video and does nothing. Invest in any of these stocks today, and believe me, your future millionaire self will thank you. If you found value in what we've discussed, please leave a like now and subscribe for more financially educating videos like this. Also, hit the notification bell so you'll be the first to enjoy and leverage our upcoming videos. And remember to share with your friends so they too can invest smartly. Please click here to watch another fantastic video. I wish you a Merry Christmas and a prosperous New Year in advance.